Dave Ramsey, I think, doesn't really like debt and doesn't teach people to have debt. I think you and I go the other way. We say there is definite good uses of debt, but you have to know what kind of debt you have and the best way to use that debt.
That's exactly right.
From Wealth Creators USA, this is From Worry to Wealth, the podcast that shatters the myths and mystique surrounding wealth creation. As students, our schools and universities often neglect the crucial education on the core financial principles. I'm Ben Lyons. I'm a business owner, investor, entrepreneur, and author, and I'm joined by my business partner, Alex Fink, and together, we're here to inspire your journey towards improving your financial self. In a world buzzing with advice on the behaviors and mindset to become wealthy, we'll share proven processes tried and tested by our network of successful collaborators. So get ready to move past worry and move towards wealth and your improved financial self. Hi, everybody, and welcome to another episode of From Worry to Wealth. I am Ben Lyons, and once again, I'm excited to be with my esteemed, looking lovely Alex Fink, partner,
yeah. Confidant.
He's sitting a little further away from me today because somehow I got a little bit of a cold, and I don't know, he doesn't want to catch it. I don't understand, but
Well, at least they're closing the door, and we're in an enclosed space, which is
right.
Makes it very easy to avoid.
Okay, so if he gets sick, I guess I'm going to be to blame.
Well, no,
But,
yeah, that's right.
if I sound a little nasally, maybe you now know why. It's not too bad, right? Is it?
You sound great, Ben. You sound fantastic.
He says that to everybody. And
yeah.
Matt Huffman, our education director at Wealth Creators, wanted me to point out that I've got ink all over my shirt. I don't know if you can see that. You know,
Those are just battle scars from the education and from all the calculations you've been doing.
Right.
Obviously.
And also
maybe that
from this
calculation
pen
could have been.
I happened to accidentally wrote it on my shirt.
We'll add this to the podcast about the mistakes that we've made in the past. And
right.
Calculation errors and determining how close your pen should be to your shirt. Go ahead, Ben.
Yeah, not very good. And
yeah.
I'm glad I did it on a custom shirt. Right?
That's right. That's right.
So without further ado, as everybody knows that has listened to us before or watched us, this is a podcast that is centered around the book From Worry to Wealth, where we really reverse engineer and explain how wealth creation happens. So here's the book for those of you who don't know what it looks like. And Alex and I spent a lot of time really every day living the actions and the fundamentals in this book. And today we're going to discuss one of those fundamentals, which has to do with leveraged finance. Leveraged finance. Well, that's a mouthful, right?
Sounds scary.
Yeah. So I'm sure our viewers and listeners have heard about finance.
Correct.
But we're going to talk to them today about leveraged finance.
Which sounds smart.
Now, I don't know how many of you know what that is, but Alex, let's cover, all the different organizations that we know that are in the finance business of some sort, but use leverage, which leverages the use of debt. Is that right?
That's exactly right.
To accelerate the return. So let's name for our listeners and viewers some different industries or different organizations that are considered leveraged financing organizations. You pick one, I'll pick one.
Mortgage companies.
Mortgage companies. That's right. How about banks?
Banks, absolutely.
Yeah. What would be a third?
Consumer finance companies.
Consumer finance companies. How about credit unions?
Absolutely.
There's a fifth one for sure, or a fourth one. We're about to get into it.
Insurance company.
Insurance company. Yes, that's right. Okay. There goes the microphone. So our list is running down.
Reinsurance companies.
Reinsurance companies. Probably really any organization like a private
auto finance company.
Auto finance companies.
Yeah. Most of the finance companies use leveraged finance. So anything that you see in the finance world typically utilizes that strategy.
So let's come up with the definition of leverage and specific to the financial aspect of it, or financial leverage. So do you want to cover for our listeners and viewers really what financial leverage means and is any terms as you...
Yeah. So the way I think about it is you have an asset, right? and that asset could be a loan. That asset could be a property. That asset could be a car or a vehicle, and you borrow against that asset, and that creates leverage.
Yeah. So the use of debt, so the use of borrowing to produce a higher return on the invested capital or the equity you have in that business. So let's look at it from a perspective of a bank or an insurance company.
Sure.
So I'll cover a bank, you cover an insurance company.
Go ahead.
All right. So let's start with the bank. So most banks in the United States, if you look up how much debt and how much equity the average bank in the United States has, the average bank has 1 part equity, so capital, and then about 9 parts or 10 parts debt. Debt comes in the form of deposits. So a bank, if you and I owned a bank, let's say we put up, let's say $5 million each.
Mhm.
And we started this bank with $10 million. The regulators would allow us to then take in about another $100 million of deposits. Now, the average bank in the United States is levered 9 times equity. So basically, out of 10 parts, they have 9 parts of debt and 1 part of equity. And I didn't understand it. It's 9 parts debt, 1 part equity, but that's actually considered a 10-to-1 leverage. I think it has to do with the fact that there's 10 total parts and 1 part is equity, 9 parts are debt. So a levered finance bank is nothing more than we own the bank. We get to borrow money from our depositors and use all of that money to make more money on our original equity.
That's right.
Okay.
Yep. That's
So-
the business.
So that's the business of banking, and this is the way most banks operate in this country. And why don't you cover insurance companies? Kind of help.
Yeah. So insurance companies work exactly the same way. You have typically a 10-to-1 leverage. You have equity or reserve capital in the insurance business, and you take on annuities or other insurance products that you have to pay for, right? And that would be considered your debt piece, and it works the same way as banks. So instead of deposits, you typically have insurance policies or annuity policies that create your capital coming into the company, and you pay for those, and they're generally a higher cost, than deposits. So banks have a little bit lower cost of funds. Insurance companies have a little bit higher cost of funds.
So most organizations that use debt, their goal is to produce a higher rate of return on to the shareholders. Does that sound about right?
That's right. Replicating your business model with other capital that's cheaper than your business model, and then you can increase returns as a result.
Yeah. So let's talk through some examples, because one of the things I always illustrate and have fun with is kind of how the Link Capital Mortgage Fund uses leverage. And
Sure.
let's just use generic examples. And I like for our viewers and listeners to play along, because this example to me is always fun, and I usually get a lot of eyebrows raised. So let's say you and I, let's use real simple numbers. We each put up,
That's good for us, the simple
because
numbers.
we need
Yeah.
simple numbers.
Yeah, because yeah. That
So
makes-
let's say John Smith, who's our borrower,
Okay.
and John Smith wants to borrow $100,000 from us. And John Smith says, "Hey guys, I've got this property. It's a rental property. It's worth $150,000. And I will let you take a first lien on that property, but I need $100,000. And I'll pay you 10%. So Alex puts up 50 grand
Mhm.
and Ben puts up 50 grand. So we each put up 50 grand and we lend it to John Smith. John Smith pays us 10% on our 100 grand. So how much total income do we take in?
10,000.
10,000. So you
Yeah.
get 5 and I get 5.
Right.
And
Which
so,
is 10% of our investment.
so
yeah.
we earn 10%.
Correct.
So we are unlevered at this point.
That's right.
And we're unlevered. Tell our viewers and listeners, why are we unlevered?
Because all of it's our capital that's producing the returns.
That's right. So all our equity, it's all our capital. Our 100,000 is working, your 50, my 50, and we're earning 10%. Are you excited about 10%?
It's not terrible, but I could be more excited. With
Not
numbers
terrible,
higher.
right? Not
Yeah,
terrible.
Not terrible. Yeah.
So all of a sudden, Wells Fargo calls you up, Alex,
Yes.
and says, Alex, we think you're a great client.
Right.
Here's what I'd like to do, Alex. I'd like to lend you and Ben $50,000. I want you to pledge that $100,000 mortgage that you lent to John.
Right.
And we're going to give you 50 grand.
Yeah. So each of our investments goes from 50 down to 25.
Yeah.
And we have 50,000 from Wells Fargo at what cost?
Let's say in this case, we're able to borrow at 6.
I like that number.
Okay. So our spread between what we lent John, what was our rate to John?
10%.
And what are we borrowing from Wells Fargo at?
6%.
So our spread is
4%.
All right. So let's do math. Let's do some math. And for those of you watching and listening, follow along. So if Wells Fargo lent us $50,000 at 6%, how much interest do we pay over the year?
3,000.
3,000.
That's right.
How much income did we collect?
5,000.
Well, how much total did we collect?
10,000. Yeah.
10,000.
Yeah.
So we collect 10 from John.
Right.
We have to pay back Wells Fargo 3.
Right.
Which means you and I split 7.
Right.
But we only put up 50 grand of our own money.
That's right.
So our rate of return is now what?
Well, it would be 14%.
It'd be
right?
14%.
Yeah.
It'd be 10 on our original 50.
Right.
And then the 4% spread on the other 50.
That's right.
So we now earn 14%. But did our risk profile to John change at all?
Not at all.
Not at all. So for those of you listening, we just turned 10 into 14 on our money without changing the risk profile. That's using leverage to increase the return. But let's take this further.
Let's do it.
Wells Fargo calls you up again, Alex, and says, Alex, we love you and Ben as clients. I know we only lent you $50,000 against a $100,000 loan to John, but we like you so much, instead of only advancing 50%, we're going to give you 2/3 of that 100.
That's right.
We're going to now give you $66,666. You pledged that $100,000 loan.
Right.
You know, the math gets a little more complicated.
It's 66%.
But
sure.
Our rate of return on our 33
Goes up.
Goes up. It goes up to 18%.
Mm-hmm.
Because out of a $100,000 loan to John, 1/3 of it was ours.
Right.
And 2/3 of it was the bank's.
Right.
Let's play one more exercise here.
Let's go to 80%.
Let's go to 70%. 75%.
75%.
Now, 80% we could do. That'd be a 5-to-1 leverage. But let's assume that Wells Fargo calls us up and gives us 75,000 of the 100.
Right.
We only now have 12,500 each.
Right.
So we earned 10 on the original 25 grand.
Right.
But then we had a 4% spread on 75,000.
Mm-hmm.
So it would be 10.
So 4 times 3 plus the 10% return.
That's right.
22% return.
22% return.
Yeah.
So for those listening, we still had our $100,000 out to John. We still charged John the 10% rate of return. But because we used debt that cost us 6, we turned our rate of return
from 10% to 22%.
That's pretty cool, right?
Very cool. And that allows us to take our equity and do it many more times.
That's right.
At a much higher rate of return.
So fundamentally, Alex,
and that is leveraged finance.
Isn't this fundamentally how all leveraged finance companies operate?
It's how they should operate.
Now, from a perspective of insurance, what do the regulators typically allow you to leverage your equity?
I think it depends on the asset, but it's 10-to-1. Spend it 10-to-1.
10-to-1.
It might be. It's 10-to-1. Similar to best.
So for every dollar we put up of equity,
right,
we can take in $10 more of premiums.
Yeah.
And then lend all that out.
Yeah, 9 or 10. Yeah.
That's
sure.
Pretty cool, right?
That's very cool. Yes.
All right. So in terms of leverage finance, one of the other things that we like to talk about, I know you and I talk about this often, but I really want to cover one more topic in this segment, and that is the arbitrage piece.
Right.
And let's use borrowing on margin as one more form of leverage, but let's also explain how we arbitrage strategies, because arbitrage and leverage aren't exactly the same thing, but they both allow you to use borrowed money to produce a higher rate of return. So why don't we cover kind of how you and I handle stock portfolios
Sure.
and how we leverage that? Why don't you cover that?
Yeah, so stock would be an asset just like a mortgage or just like a car or just like a house. So you have an asset and you borrow against that asset, and that borrowing rate is based on your credit profile and how much you're borrowing. And so let's say it's 6%. So let's say average stock portfolio over the last 15 years has yielded 8. Yeah, eight's low, but let's call it, yeah. So eight's a good number. So if you can realistically assume and based on the last 15 years of history, that on average you're going to produce an 8% return. You have an asset producing 8%. If you could borrow against that asset at 6%, you could invest more money at 8%, right? Or you could buy a property, take a mortgage, or do that sort of thing. And the delta between the cost of those funds and what you produce is your arbitrage.
So, Alex, I know that you and I regularly borrow on our stock portfolio.
Sure.
And we buy real estate with that stock portfolio loan. We originate mortgages, and in many cases, we're making double the returns. We're taking
Sure.
that borrowed money at 6, and we're making 16. We're making 26. And really, instead of selling our stocks, liquidating that, and using that money on an unlevered basis,
Yeah.
we're borrowing against our stock portfolio to buy more assets so that while we're taking on more risk through that process, we're really arbitraging the cost of money from what we borrow on our stock portfolio to how we
That's right.
invest it.
And we may also have a need to buy an asset, and having learned what we've learned and having the knowledge that we have today, typically I'm trying to place, rather than taking my own cash and investing in an asset that just sits there, I'm actually creating a financial structure and making an investment and taking a line of credit against that investment to make that real estate purchase. Then we're going and taking a mortgage against that piece of real estate and using those funds to make further investments as well. So that would be almost like a double leverage scenario, right?
Yeah.
So if you were to go and buy, let's say you were to go and buy a $200,000 townhouse right now, I'm guessing you wouldn't just take your cash that's, you wouldn't pair out of a stock portfolio and take the cash. Or if you had that cash sitting there, what would you do? Let's say you had your cash, let's say you sold a property, had that cash sitting there. You wanted to buy another property. Let's forget about the tax implications of the 1031 exchange. Let's say you have $200,000 sitting in your checking account. What would you do?
I think today I would put it with hopefully we can say this, probably Morgan Stanley.
Yeah.
I would invest it in a properly
Could be Morgan
allocated.
Stanley, could be UBS, could be anybody, but yeah,
I would invest it in strategic public securities, and I would take a loan against that and buy the property with it.
Correct. Yeah, and I would do the same thing. And in fact, I am doing that this month. I've got a townhome I'm purchasing for under market, and I'm establishing a new investment strategy for that money, taking a line of credit because I know I can produce minimum 10% return. I know my line of credit is only going to cost me 6%, rather than having that money just sit in the house and not have it earning money in two places, right? Because in the house, you can rent the house. The house is going to appreciate. You have those streams of income, and you take a mortgage against that if you want, make further investments. So that's the strategy that we utilize.
Yeah. So talking about arbitrage, I think one of the important lessons, you and I just came off of a podcast discussion with Henry Shuffler. And one of the things that we brought up with Henry, and that when we asked him a few things that he regretted in terms of his decisions, and we talked about paying off low interest debt,
right,
as a bad way to arbitrage, because what Alex and I do and what we teach is investing and professional investing. And really what you want to look at is you want to look at what is the cost of of the debt that you have on certain assets, right? Because if you've got there are people that are saying, I'm going to pay off my 3% mortgage on
For sure.
a house.
Yeah.
Why don't you touch on why that is a terrible idea?
Sure. Well, I've had a few family members that have asked me for advice in this regard. And I think the conventional thinking is I'm going to get a low interest mortgage with the goal of, assuming we're talking about an investment on a piece of real estate, I'm going to take a low interest mortgage and I'm going to work really, really hard to just pay down that investment and have that asset on free and clear so I don't have any more debt, right? That pains us to hear, right? And I've had to attempt to sort of, coach certain members of my own family through this, where I say, okay, well, let's say you have a 3% mortgage, right? And all you're doing is you're paying down that 3% mortgage with your disposable income. Great. But what if you took your disposable income and instead of paying off that 3% mortgage, you invested that money in a strategy that earns you 10%, right? That seems like a much better strategy because your 10% returns can now pay down that 3% mortgage. And so let's say you have a $500,000 3% mortgage. If you pay that down, what do you have, right? You don't have that $500,000 worth of debt. So you've got, let's say the house is worth, $500,000, right? Even though it's probably worth more. All you have is that $500,000. Well, if you were to use that $500,000 to pay down the debt and make another investment of $500,000, use those returns to pay down the other $500,000 of debt. Now you just now you have $1 million. You just doubled your money by changing your investment strategy.
Yeah. So in the same period, in other words, instead of retiring low interest debt, acquire more asset value.
Correct.
So that gross asset value can make money for you, as opposed to just retiring a 3% debt.
With the assumption that your asset is producing a higher return than 3%.
That's a key component.
Conversely, if you had a mortgage at 18% and your investment strategy yielded 10%, that would be a very bad idea to go and invest more money at 10% when you could pay down debt at 18%.
That's right. And that's why in our courses, we talk about good debt and bad debt. And one of the definitions we have of bad debt, first of all, consumer debt is bad debt. But if consumer debt is very cheap, you don't want to pay it off.
For sure.
Even if it's consumer debt. So there's a component of what's the cost of the debt relative to the solution to investing.
Right.
And we're coming off low interest rate environment where there's a lot of consumer debt and a lot of business debt that was very low for cost. People are crazy to pay that debt.
Yeah. You have a positive arbitrage, you have a negative arbitrage.
That's right.
To a positive arbitrage.
That's exactly right.
Yeah.
So that kind of rounds out our lesson here on understanding how to use arbitrage and understanding arbitrage, good and bad, and understanding how to use leverage. And Dave Ramsey, I think, doesn't really like debt and doesn't teach people to have debt. I think you and I go the other way. We say there is definite good uses of debt, but you have to know what kind of debt you have and the best way to use that debt.
That's exactly right.
All right. Any parting words on this topic? I think we covered leverage, finance, arbitrage.
I think it's probably the biggest mistake that I've made in my life is not utilizing that strategy sooner.
Yeah.
Would you agree with that on your side?
I think running, I've had some businesses that I made mistakes in how I ran them, probably overshot how I use leverage and debt, but certainly up there in the top 2 or 3.
Yeah. Now, so at what age did you start using leverage?
Well, I started buying real estate when I was 19.
Yeah.
So 19.
Well, what about in terms of just stock portfolio investments?
Not till much later.
Yeah. So I think a lot of real estate investors like us, they really understand leverage on the real estate side.
Yeah.
But they don't really understand leverage in the traditional investing sense, stocks and stock portfolio.
Yeah.
So that's for me, I think an area where most real estate investors could do a lot better.
Yeah, it's a tenet and a principle of the wealth creation formula. It's such an important thing to teach, and I would encourage all of our listeners and viewers to really take us up on our education around leverage and arbitrage, because wouldn't you think that this whole topic of leverage is probably top 5 of important principles of investing?
In the sense that you can build wealth much more quickly. Yes. Yeah. It's pretty easy to build wealth. Anyone can be wealthy over a long period of time. Anyone can. The use of leverage accelerates that process tremendously. And once you have that wealth, it becomes exponential in a leverage scenario.
Yeah, and I'm sure some of our viewers and listeners are going to say, but yes, when you take on leverage or take on debt, you take on more risk as well when the market shifts away from you. When that's fundamentally true.
True. Absolutely true.
Yeah,
It's the same of having a mortgage on a house, right?
yeah.
So no different.
I think the philosophy that Alex and I subscribe to is that, if you go the 40-year route of investing in public securities and investing solely in the stock market, not taking on risks, you're too old to enjoy your wealth anyway. And from our perspective, and really without the use of leverage, it's tough to accelerate that 40-year plan down to 10 or 15.
That's right.
All right. Anything else on this topic you think we missed?
We could talk about this for days. So I'm sure.
We could. All right. Well, thank you for being with us in this episode, in this topic of leverage, and we'll see you in the next episode.